Today I want to show you my 8-month-long battle with XLE, which is an energy ETF. But before I go into it, let's talk about my trade number 246. It was an Amazon trade, and for those of you who are new to my channel, I document one of my option trades every single day for your benefit so you can learn from it. So my trade number 246 was a pretty basic $90 put option. It's called a naked put when you only sell a put option. And what made me decide to sell the 90 put was the fact that today the price went down. So I figured that the $90 put option should be fairly safe, even though the overall market is not looking really healthy at the moment. We can still expect this price to come back down, but this was one of the trades that I thought that it should be okay. Even if the price comes down a little bit, I should be fine. If I look at the option chain, the volatility for the March expiration is at 40. The IBR is only 20, so it's not ideal for strangles. Preferably it needs to be above 50, but in this case it's a directional trade. I believe that the stock is going to go up at some point, or at least stay at this level. And currently the $90 put option is paying 125. I received 128 for it. And if it goes up tomorrow, if it bounces back up, like we can see that today it dropped $3. If it goes up by $3, then I should be able to close it fairly quickly, but I don't have the intention to rush with it. The probability of profit is 79%, and I've got 29 days to be right with this trade, and even if it works against me, I can still roll it. So let's talk about a more exciting trade, my XLE. Now this was a fairly challenging trade. It required a lot of patience. I opened the trade originally on the 13th of June, which was right here, when the price was all the way up to 93, and then it suddenly dropped down to 82. That was the low of the day, and at that point I decided to sell the $70 put option and the $95 call option. As you can see, it was a very wide strangle, but then the price just continued plummeting and went all the way down to 65.48, and that obviously didn't go very well with my strangle. My put side was heavily tested, so I needed to make a bunch of adjustments. And if we take a look at this diagram shows exactly what happened. So the blue candle chart indicates the price movement. It's exactly the same as what you can see over here. And the orange line is showing my call position, so the call options that I sold. As you can see, as the price went down, I just kept on rolling down my position and collect additional premium on the way. And I kept my put position, which is the green line, at the same level. That's basically how you need to make adjustments when something goes against you, when a price moves against you and you have a strangle on. This is how you make adjustments. You basically adjust the winning side, not the losing side. The losing side just stays at the level where you originally had it. This dotted line over here shows the premium, the total premium that I collected. So as you can see, every single time I rolled my call side, I collected additional premium. So that's why the premium just keeps going up. And then at this point, when the price hit the lowest point, the XLE price hit the lowest point, I was already at a straddle. So this is when your call and the put strikes are on the same level, it's called a straddle. It's no longer called a strangle. I didn't want to go inverted with this particular position. Inverted means that your call strike goes below your put strike. I didn't want to do that because I believe that the price is going to go back up, and my assumption was correct. The price went up and it moved very quickly, very far, so that gave me additional challenges. And at some point when it reached the level where I originally started, I was heavily tested or heavily in the negative on my call side. My put side was fine, but then the price went back down again quite rapidly. So at that point, I had my straddle on. I had plenty of premium in the trade, but I had too much time. So I couldn't close this. I couldn't get out of this trade with a profit. So I just had to keep rolling, which means you either move your call side or your call option strike, or you move your put option strike, or you move out further out in time. So for example, you sold a March expiration, then as you get closer to the March expiration, you can roll your position to April and collect additional premium. So what happened in here, as we can see, my total premium dropped significantly because I collected a lot of premium, but after the price dropping again, if we go over to this trading platform, we can see that the price went up to 82, and then it dropped again all the way down to 68. So once again, it was a huge move, and that didn't go very well with my position. So I needed to sacrifice some of my premium, and that's exactly what I did when I rolled from 1 month to the next. I had plenty of premium, but my position was in the red, in the negative, so I sacrificed some of my premium to widen my strikes. As you can see, I was inverted at that point. The green line, which is my put position, was above my call position, and I needed to make adjustments. So I dropped my put position all the way down to this level, and then I kept my call position. In fact, I moved my call position up a little bit. So I widened my strikes. This is what we call widening the strike. And then further challenges came along. XLE went from the 68 mark all the way up to about 95-ish. So I just kept rolling my put position up, but I was stuck with my call position, and as you can see, the gap was very, very big. My call position should have been above the price at that time, but it was heavily below. This is called in the money. My put position was fine, except in some instances where the price dropped below my put strike, but this was a really, really tough position. So once again, I kept collecting heaps of premium on the way, but then I had to sacrifice a lot of it, so my total premium dropped again significantly, but that allowed me to improve my position. And then when I reached this point, which was roughly about here, in December, the price finally stabilized a little bit. So I was stuck with a straddle once again, and I just sat on it. And I waited for about a month before I made another adjustment. And eventually I ended up with my straddle. I had the $88 straddle. And if we jump over to the platform, we can zoom in and we can see that the price finally landed around my $88 mark. And that allowed me to close my position because I had my February expiration. So if the price didn't go down to 88 at that point, I had plenty of opportunity to roll out my position again. I can show you that if we go over to the option chain and we simulate the position that I had, I would have had to purchase back my 88 put and my 88 call and go for the March. Let's say I could have sold the same position, 88 call and the 88 put, and that would have given me $4.40 extra credit. But that would have been a silly move because straddles are quite risky. Basically, what you're banking on is that the price is going to land exactly at the same level as your strike. So the probability of that to happen is quite low. So what I could have done, or what I would have done, is I would have widened my strike. I would have rolled to, let's say, 82 and 90 on my put side, and maybe up to 94 on my call side, and that way my delta would have been at minus 21 for the put side and 17 on the call side because I'm a little bit bullish on the energy sector. So this move still would have given me 45 cents credit and would have bought me 29 days extra. But I wanted to close this deal because if we zoom out on the daily chart, we can see that the volatility has dropped significantly. The IV rank is only at 8.7. So when you have a strangle, like I said earlier, ideally you do want to close it. You want to get out of it when the IV rank is low, when the volatility is low for the given stock, because if the volatility goes up, then you're going to get hurt on both sides, because both the call and the put option values will go up, and that would hurt you big time. So I wanted to get out of this trade, finally managed to do so after 8 months of battling. As you can see, patience pays off, and also the frequent adjustments pay off. And what I ended up generating with this trade was a 37% annualized return, which if I told you that give me $1,000 and I'll give you 37% return annually, then surely you would jump on it. So after all this battle, after all these adjustments, I was able to get out on top. So this is how patience pays off when trading options. And another thing to keep in mind is, imagine what would have happened if I purchased the stock on the 13th of June. So at that time, the price closed at 84. So imagine that I would have had to hold that position for more than 4 months to start seeing a profit. And today the price is at 87. So after 8 months, the price improved by $2. So you wouldn't have made a lot of money. So in my opinion, it makes a lot more sense to trade options than to buy stocks, unless you're confident that the stock that you or the company that you invest in is going to go up in value. With XLE, it's an ETF, it's an energy ETF, and yes, it can go up and it can also go down. If we look at the monthly chart, it's currently near the all-time high. So anyways, I hope that you find this video useful. I hope that you learn a lot from it. And if you haven't done so, please subscribe to my channel and spread the word and trade options and trade them frequently. Thank you for watching.